Hey, good morning, options traders, and happy Friday, everyone. And today is February 18th of 2022, and as you know, in the past couple of weeks, we've seen some extreme volatility, and it looks like right now at about 9:15 that the futures might pop a couple of points, but we'll see if it holds. But I thought this might be a really important video to talk about. It really applies at all points in time, but especially when the markets get volatile. And it's more about decision theory and how to make better decisions. These are some things that I will be including in future videos for this year. But one that I think is super important for traders to understand is the inside view versus the outside view. What does this mean and why is it important? Well, one of my favorite quotes in risk management is from economist Elroy Dimson, who said that risk means that more things can happen than will happen. So it's a fairly simple definition. It's not one that you're going to see in the textbooks, but it really captures the essence of risk. You see, we always think that whatever the outcome is, that that's what was destined to happen. But we rarely think about that there could have been a ton of different possibilities. And this is so true when it comes to trading. And so as you're making decisions, instead of just saying, oh, here's what happened to me last time I wrote that call, or here's what the market did today, understand there are a lot of possibilities, and you need to take that into account. And this is where the inside view versus the outside view comes in. So whenever we talk about the outside view, it really means that it's an objective, long-term, maybe you can think of it as a scientific view. But you're thinking about all of the possibilities over the long run, and when you consider all of the things that could happen. The inside view is a subjective view. It's short-term and it's biased based on your viewpoints, based on what's happened to you. Could be based on, oh, I'm feeling lucky, or I just feel like I've really got a handle on how the markets are moving. That's an inside view. It's very subjective. And here's where it can cause problems. Let me start off with a simpler example, and then we'll move to one that's not quite so obvious. But let's take a look at roulette. So roulette, game in Vegas that you see all over the place, any casino, and lots of different types of bets you can place on roulette. But a very simple one is to bet on red or black. So let's say that we bet $1 on either red or black. You can think of it almost like a 50-50 bet. Roughly half the numbers on the wheel are red and roughly half are black. But it's not quite that easy. However, Vegas offers a 1-to-1 payoff as if it were a 50-50 bet. See, if we flipped a coin, then you should be willing to pay $1 for every dollar that you could win, because heads and tails are equally likely. But in the casino at roulette, that's not quite that easy. And that's because you've got 38 spaces on the wheel, but 18 of them are red and 18 are black. But there's 2 greens, and that's your 0 and double 0. So really, if you, doesn't matter, pick one. If you bet on red, you've got an 18 out of 38 chance of winning. So if it were purely a fair game, you should have an 18 out of 36 chance of winning. But it's not. It's ever so slightly stacked against you by these extra 2 spaces. And if we run through the math, you'd find out that it's about roughly a 5 1/4, actually works out to be 5.26% edge against you. So there's 2 views that we can have. We can have an inside view versus an outside. So the inside view is, oh, I'm feeling lucky, or it's Chinese New Year, or it's Venus aligned with Mars, or hey, I did really well at roulette last night. I feel like I've got the hot hand going. I feel like I'm going to do well. That's a subjective view. That's the inside view. But what's the outside view? The outside view might be, well, let's stand around the tables and watch. Or more simply, let's do some computer simulations. So here's one that I did in Excel for 3,000 spins of the wheel. Now keep in mind that the 0 line, your break even, is right here, this bold line. So we didn't do too well this time over these 3,000 spins, and it's easy to think that this is where it was destined to go. After all, this is the actual result that we got. But to succeed at trading, you need to understand that we have one past, but we've got many possible futures. It's not good to say, oh, this is the way that things are always going to turn out, or let me never do this strategy again because I had a bad outcome. We have to realize this is one of many. We want to look at the outside view. What's likely to happen? So if we do that, we could run a simulation. Let's try it a second time in Excel. And if we do that, we might get this. Actually, a fairly similar looking path, but not identical. And if we did it thousands of times, we would get this. And now we start to get a clearer picture of the outside view. If we think of all of the possibilities for roulette, this is what we're likely to see. And if we ran the math, we would find out that after 3,000 spins betting on red or black, over 3,000 times at $1, that the expected value is we should be down about $158. And so that's down here. This is what we should expect. This is a great, simple example of the outside view. Now, yes, you can see that on some of these tries, especially early on, we actually beat it. We were actually above the black line. We were positive, and here we got way up. And this might lead you to believe that you've got some kind of a hot hand going, or that the wheel is unbalanced, or for some reason you have an edge. And traders just don't realize this is the nature of randomness. We want to look at the outside view. What is most likely going to happen? You don't want to use that one result and say this is what you should expect. Okay, so this is a good example because the wheel never changes. It's always 38 spaces, at least for a US wheel. It's always going to have the same outcomes. It becomes very mathematically destined. But it's not so true in the real world, but we can still have the same mentality. So here's a very good example. Let's take a look at horse racing. So back in 2008, a horse named Big Brown was the overwhelming favorite to win the Triple Crown. And he had already won the Kentucky Derby, and he had won the Preakness Stakes. And the Kentucky Derby, even though he was not the favorite to win, he won by 4 3/4 lengths. For the Preakness was not favored, won by 5 1/4. So for the upcoming Belmont Stakes, which is what he needed to capture the Triple Crown, you're thinking, wow, he's got a really good shot. He's destroying all of the other horses. And his closest competitor, a horse named Casino Drive, actually dropped from the race just before the race, so he was out of it. So now you're thinking, okay, now it's looking really, really good. And in fact, the horse's owner said, it's all but a sure thing. So if you were to bet on Big Brown back at this time, how would you rate the chances of winning? You would probably say, oh, they're obviously very good. That's what everybody thinks. He's destroying all of the other horses. He's got 2 out of 3. Let's bet heavy. But see, that's the inside view. And both of these races in the past are one of many possible outcomes. But we don't see it that way. We just say, oh, this is the only thing that could have happened. It was destined to be here. He's definitely going to win. But let's back up and take a bird's eye view and look at the outside view. If we go back in time, only 11 horses earned the Triple Crown in the previous century. Now think about that. Of course, we're talking about since 2008, going back 100 years, 11 have won it. None in the past 30 years. So the outside view says of the 29 horses with the possibility to win, only 11 succeeded. This is looking a whole lot different. We're now looking at it more like spins of that roulette wheel. The more realistic view is to say there's more like an 11 out of 29 chance, or about a 38% chance to win. And in fact, this was very close to what a lot of the odds makers were giving Big Brown at the time. And people are standing around scratching their heads going, I can't understand why. This is such a done deal. Well, what do you think? How did Big Brown do? Well, it turns out he came in dead last. Never been done in horse racing history before where a Triple Crown contender finished last. Now think about that. He was such an overwhelming favorite, and never in the history has one finished last. But see, this gives you a different perspective when you start thinking that there are many possibilities. Now what's interesting is the horse was given a full checkup and not a single thing wrong, or at least anything that they could find. But you have to realize these horse races are done within about a 5 or 6 week period, very close together. They're expending lots of energy. Who knows what happened? Just because they didn't find anything doesn't mean that something wasn't wrong, or just bad temperament that day, just didn't feel like racing. But see, that gives you the outside view, recognizing that there are many possibilities that could happen. So for your trading and when you're setting up your strategies, think outside. So a very good example is, let's say, with a covered call. You might have the stock trading for 200 and you say, well, you know what? I really think this stock is going to make a huge move. I don't want to see it go in the money. I don't want to see my shares called away. So let me sell this 1 week 240 call and I'll pick up 50 cents for it. Well, you didn't really create a downside hedge. All you've really accomplished is sealing off the upside. It's not really the essence of the strategy. Well, let's back up and think. This is a 20% gain, which, yes, is big, but you have to say 20% in a week? How often does that happen? Now, of course, don't say, oh, it could happen. Of course it could happen. That's the inside view. It could go to 300. It could go to 500. Those are all possibilities. They're just not very likely. You need to step back and say, what is most likely? Make sure you are getting a good hedge. Make sure you're getting some premium, and make sure you're allowing for some good rewards. And when you do that, you'll start having better success with your options strategies. And that's because you're thinking outside. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.